Thank you so much, SOSV. This is going to be a great conversation that I'm really excited for with these three leaders of these three very interesting and very active companies. I'm joined by Bessie Schwarz of Floodbase, Max Clarke of Plover, and Sid Jha of Arbol. And I think maybe the best way to start would be to have them just talk very briefly about, all the companies are related and work on similar things, but it is a little different. So I think the best way to start would be to have everyone just talk about what their companies do. And Bessie, since you're on the left of my screen here, let's start with you.
Yeah, happy to. And really excited to be here on this panel with these other awesome companies. So I'm the co-founder and CEO of Floodbase, and we focus on the most common and costly disaster. So Floodbase is an AI platform that designs and administers flood insurance for the trillions of dollars of risk that cannot be covered by legacy flood insurance products. And we do this using a proprietary technology we've invented with satellites and computer vision in order to monitor flooding anywhere around the world and pay out virtually automatically when we detect floods happen. This is a product type insurance called Parametrics, which I know Plover and Arbol are also big experts in. So very focused on that particular peril.
All right. Thanks so much. And Max, let's hear from you.
Yeah, likewise, a pleasure to be here. Plover is a software business with the mission to grow the market for parametric products. We do that through a combination of services and software. We are a specialty brokerage that has automated the process of quoting and ultimately selling parametric insurance for flood, for wildfire, for hurricane, earthquake, etc. And so likewise, very excited to be here and talk about how technology can help expand coverage in the light of a changing climate.
Great. Thank you. And Sid.
Yeah, thanks for having me here. It's a pleasure. Arbol is a climate insurance, climate financial products entity that our mission is to broaden the adoption of climate financial products for climate adaptation. So we cover perils ranging from heat waves and low rainfall to hurricanes and low wind speeds for renewables and many other such markets. We work across agriculture, energy, insurance, reinsurance, and our overarching mission is to bring all the pieces of the process to in one place. So from the clients to the technology to the structuring to pricing and underwriting to the capital. We work around the world, and we are very much focused on the growing coverage gap in the climate space.
All right. Thanks so much, everyone. And Sid, actually, I wanted to go back to you really quickly. I guess a question I have as a reporter who works in a climate newsroom, so we're writing about climate, extreme weather and disaster and peril all the time. I guess my question then is, why does a product or products like the ones you have to exist? Like, why can't traditional insurance products work for the perils that you guys cover?
Yeah, great question. The way insurance was designed initially, and it really hasn't changed a whole lot, probably in the last 40 to maybe 100 years, is it's based on subjective loss assessment. It's based on, basically the insurance company estimating what the cost of an event is. And what all of these things do is they make the product not very scalable. It works in some areas for some perils, but when you start to have more frequent storms, more frequent events, and more importantly, populations living in more vulnerable areas that previously did not need that much, insurance coverage, it's not a very flexible model. You need specialized adjusters after an event. You need a lot of specialized infrastructure. Contracts are extremely complex. You have also a very mismatched power dynamic. A very well capitalized, powerful insurance company on one side, and a consumer who's not really in a position to get into the weeds of a contract. So a lot of these issues make it difficult to scale coverage. And as we have new areas, people living, much larger populations living in hail, tornado, hurricane, wildfire areas, you need to scale that coverage quickly, and insurance is really not able to meet that challenge.
And to just directly going off of that, Bessie, my question for you with the parametric products that you guys are involved in developing, we hear so much about, especially around flood cancellations, people not being able to get insurance. But then how do people find out about these parametric products? How are they being sold? Is it a push? Is it a pull? What is your experience with that?
Yeah, that's a really good question. I'm actually would love to answer that by dovetailing on what Sid said, because I completely agree that the products that we offer in insurance work for some things. I actually don't think that they're fundamentally broken, but they are just not designed inherently to cover the majority of risk. So I'll focus on flooding because that's really our area. So a traditional product, generally an indemnity product, is really designed for primarily property damage. It can do some other things around the edges. And so that process that Sid was just talking about, where you simulate risk, generally through, in this case, a flood model. It's running various simulations to try to figure out risk. Works well. It's a little bit of an old school way, but it works well. And then you have a person with a clipboard go assess the damage and then give you how much they've estimated damage you have. It can be slow, but the idea is that you get the exact amount of actual property damage that you've had. That can work for some things. It does not work for non-damage business interruption. It doesn't work for places where there just is no field adjuster presence, which is the majority of the world and many of the places that we're working in the developing or middle markets. It doesn't work for contingency risk, supply chain risk in most cases, and it's also quite slow. So while it might be the exact dollar, it's not going to be fast, and it's not going to be flexible, meaning you get it to rebuild your property. So good for many types of damage from an event, but as we all know, the damage from a flood or a fire is much more holistic than just the physical property damage that you're rebuilding from. And so sort of in my opinion, the kind of products that we're all offering here are really designed to cover most types of risk that just is not available with these older products. So what we're doing with Parametric is then judging whether or not an event happened and paying out based on that almost automatically. So there's a lot more to talk about with that. But then to come to your question, Matthew, now that we can fill these gaps that we really, the insurance market has not traditionally been offering, and that therefore clients have not traditionally been purchasing, I actually think the gap becomes a lot about education. Someone is not used to purchasing, whether you're an individual, you're a business, you're a government at even the national level, you're not used to filling this gap, at least with this product. You're not used to covering your non-damage business interruption. You're not used to covering the course for the golf course, which is actually not able to be covered generally by traditional insurance. And so I think the way that primarily this is done through brokerages, but there's a variety of distribution methods, educate various end buyers at all scale that this kind of risk management is now possible and they can think more holistically about how they cover risk, I think is the big barrier. And I think really connecting with the various end buyers about their specific pain point, whether it's crops not being able to get to market during a flood, if it's a golf course needing repairs for, not being able to golf while the course is underwater, or it's a government that is on the hook for a lot more than public property damage. Like, we need to educate them in the way about the risk, about the specific pain point that they have, in order to just build up the sort of education and to purchase these and fill these gaps with these new products that are now available.
Yeah. And so I think leaping off of that, I think Sid has kind of established why these products might be necessary. Bessie, you've talked about, how we should find out about them, what use they have. Max, I want to ask you about kind of what are the kind of public policy and then, financial services industry policy barriers to actually offering these products? Let's just talk now in the United States, across the country.
Yeah, that is a good question. The answer is kind of like a combination of commercial and regulatory, and also like what I'll call human geography questions. As Sid kind of pointed out, people are moving and building in places where there is higher risk of exposure. And if you are an insurance company that has traditionally sold property insurance, usually you are trying to evaluate, right, and see how you can make money by insuring a given location. And unfortunately, that is like harder and harder to do, which is why you see in places like Florida, in places like California, and other places, markets, insurance companies choosing to leave and not write entire states or entire geographies versus write them non-commercially. A big part of the reason that they can't write them non-commercially is that the exposure has changed, but also that the regulators are not allowing those insurance companies to increase the prices on products that exist in the admitted market, right? That's home insurance, it's personal lines products, it's small commercial, et cetera. And so really what you see is a enormous flight of exposure from the admitted markets to the excess and surplus markets where products like parametric products, although certainly not only parametric products, can help fill those gaps and basically help people get the coverage they need at a price that hopefully they're able to pay. If that process is going to be fixed, I think there's a lot of different like regulatory kind of decisions that can help accelerate it. Parametric products are not new. They've been around for a long time, but certainly many insurance companies, I think, have pause around the fact whether insurance products that are parametric are going to be regulated as insurance versus regulated as derivatives. There's oftentimes, it's important. It's like a contextual analysis that really dictates whether a product is one or the other. Clarifying that, so basically, CFTC action stating that all parametric insurance will qualify for, the same insurance safe harbor as all insurance products do, I think would help. Similarly, I think pronouncements by the IRS, much to the same, would help. And then lenders being more accommodating of products in places like California, Florida, and elsewhere from the perspective of insurance that does or doesn't satisfy obtain and maintain requirements would also, I think, accelerate adoption. At the state level, you also have 50 states that have to amend their insurance laws describing what insurance is and how it works. So there's definitely a lot of work to do, which is why I think the opportunity is large and also complicated.
Yeah. I know as Paul Graham says, do things that don't scale. It seems like going in front of 50 insurance commissions and the CFTC and the IRS would be a classic example of something that doesn't scale very well. I guess, Max, to kind of follow up on that, is there a world in which these types of policies get out of the E&S world and into the admitted world? And how would that affect what you do?
Yeah, I think like that world is already here in a small number of cases. So there are certain states in the US that have already made the decision to admit parametric products. Usually they are for smaller limits, and usually they are for what I'll call narrow use cases. So I think like the overall trend is quite positive. We've also seen wider adoption of these products in certain, more niche spaces like the captive insurance market. Certain states have basically affirmed that parametric insurance contracts are, acceptable and sellable in the captive space. So I think that will continue for sure. I do think that, more full-throated adoption or promulgation of some kind of like model act by the NAIC, for instance, would definitely help push states toward faster and wider adoption. So we'd be excited to see stuff like that happening as well.
And Sid, similar question to you. What are kind of the regulatory or financial logistic barriers you guys have had to expanding your business?
Yeah, that's a long list, to say the least. I think, we actually started very in a different route. We actually started more with derivatives, transacting parametric products with more sophisticated counterparties, which is a requirement on the derivative side, and then added insurance after that. Because part of it is, yes, the fragmentation of regulation across 50 states does make it a challenge as a smaller entity to get all those licenses in place and make sure you're adhering to all the regulations. I agree with Max that I think the admitted product list will start growing. It's something that we are also very focused on. I think the future for parametric, especially in the property and so real estate space, if you will, is hybridization, where parts of your policy are traditionally adjusted. Because again, we're not there yet where the whole thing, your whole home insurance is not ready to be parametric anytime soon, right? That would require a very different landscape of sensors and things like that. So part of it is traditional, and part of it could be parametric for the growing deductibles and exclusions. And so those kinds of things would be ideal as an admitted add-on rather than as a surplus add-on, because then you're mixing a lot of different regulations around surplus lines versus admitted lines, which operate very differently. I think we operate internationally, and when you add that, the outcomes rapidly grow in terms of possible regulatory barriers. But yeah, getting MGA licenses in different jurisdictions, getting comfortable with insurance versus derivatives law. A lot of countries are actually only now starting to even have separate laws for parametric. One of the other interesting regulatory blockages that we run into is the inability of many jurisdictions to handle collateralized reinsurance. It sounds like a very niche issue, but that actually keeps capital out of these markets, right? Everyone wants a rated reinsurer, for example, but the other route is to have a non-rated reinsurer who puts their money in collateral in trust as security. But many jurisdictions are unable to handle that route. But if you want to get alternative capital in these markets, that's your fastest way to get that going. So it's not just on the consumer side. There are a cascade of issues you run into because we operate from the start to the finish, so to speak. There's a cascade of issues you run into as you try to expand these markets.
So I think everyone watching this will know why there's demand for these products, but I want to talk a little now about the supply side, about the kind of technological, especially both software and hardware innovations that make these types of products possible. So Bessie, I was wondering if I could ask you, because I know you've done a lot of work on this. What is their kind of the technological developments of, say, the last decade that have made Floodbase's products? What are the big ones that make what you do possible?
Yeah, there have been several, but I think there's really three key big trends that have enabled the kinds of insights about risk, both in near real time and about risk overall. And those would be parallelized computing, so just more computing power. There would be the availability of direct observations, not just simulations. For us, that really starts with a plethora of satellite observations of the entire globe from a variety of sensors in the air that now have long histories. And then, of course, computer vision and AI, which just crunches all that data better. It really is the combo of all of those in concert that lets us analyze the Earth and phenomena in a fundamentally different way, which I would say is based on direct observations of the phenomena and then making inferences from that, rather than having to run simulations based on less data, which does have a real role. And there's real things that a climate simulation model can do to try to understand what's going to happen in 500 years in this location or 100 years, or a hurricane where we don't see a hurricane of this type happen very much. And so we need to run 10,000 simulations of that to try to understand. There's a real role for that. But with those three trends that I've just talked about, we can actually use a lot more direct observation, which has just a lot more both precision and accuracy over time and space. And so our data is equally accurate in where we work in Nigeria to help with predict famine for the US government and governments there, as we do for golf courses and Formula One in places in the US.
Great. And it wouldn't be a panel hosted by a VC firm if I didn't ask a question about artificial intelligence. Also on my mind, I wrote a story about OpenAI yesterday. It's also on my mind as a journalist because I worry that my job will soon be replaced by these things. So before that happens, Max, I was wondering if you could talk about how you use AI and what new AI developments actually are you using every day in your business?
Yeah, absolutely. So I think everyone obviously does love to talk about AI, and I think in insurance in particular, there are clear applications for those kinds of technologies for certainly Gen AI as well. But we see, frankly, most of the value, certainly most of the use cases that we use AI for on a weekly or daily basis to be, I would say, like a little bit like smaller, a little bit less, call it in vogue in the large language model sense. There are a lot of data science and data engineering problems that, due to the scales involved, require sophisticated but certainly not particularly new AI techniques to process and basically do in a way and at a cost that is achievable and sellable. And so on the climate side, there are certainly issues like those that Bessie flagged. Those same problems exist outside of property as well. So honestly, though, like I would say a significant part of the value is in technologies that are kind of far to the left of AI in terms of complexity, which is a good thing because AI is also, it's very exciting, but it's also very new, particularly some of the generative applications that everyone is getting very excited about. So maybe that's like a halfway dodge to the question, Matt, but
it's okay. Sid, same question to you.
Yeah, so I have a academic background in math and stats, so I was obviously get asked a lot in VC meetings, and my first thing is that it's basically graduate level stats being given a nice marketing, label. So that's fine. For us, this was actually the core of how it started. We didn't call it AI. We never branded it as such, but all our underwriting is algorithmic, and it is essentially working through the there's a different kind of AI you need if you're trying to get the 0 to 15-day forecast better, right? And that's like Google's GraphCast, and some of these other things have done amazing work in that aspect. Where we operate is in the sort of 1 month to 11-month out window, right? A lot of our business is seasonal stuff, right? Farmer comes to ask for drought coverage, or wind farm says, I need the 3 to 6 month period. I just don't want to deal with low wind speed hurting my revenue, etc. So in that realm, it's been very interesting to sort of watch as we've been working, and we're constantly hoovering up academic papers on the topic, but AI is starting to make inroads in that arena, which is the sub-seasonal to seasonal window. There, it's a much more of a statistical, less physical aspect, though there are some physical processes that do matter, but the mindset is very different. And so there, we spend a lot of time and effort in constantly improving those aspects. So what are the different trends going on in the climate space? As Bessie mentioned, the availability of satellite and other types of data, obviously, it starts to become not just a nice to have, but you kind of need a lot of, again, machine learning statistical techniques, some of which you would call AI in some ways. But you need a lot of that to make sense of that time window, and to say, okay, what is the likelihood of heat and dry? How correlated is it going to be? The other aspect is we are running portfolios of these risks for our capital providers. For us, it's not just about the chance of a heat wave in a particular area. A lot of the work for us is around, well, what is the chance that they all get correlated? What is the chance that you'll have a drought and a heat wave in both the US and Europe, as well as in Australia, right? Those are the things that will actually start to top up losses far greater. You can have a little bit of a drought here, maybe it's a flood in a different area. As long as the risks are balanced, we're okay. If risks get unbalanced because of how climate zones, like imagine a simple example is El Nino happens, well, now a whole bunch of areas of the world get correlated. So how we sort of deal with that constant shifting stuff, and I was a systematic trader on Wall Street, so there was a lot of this kind of similar mentality. I'm trading oil, I'm trading cotton, I'm trading zinc, I'm trading corn. Okay, they're not exactly related markets, but they do have common threads. So that kind of stuff forms a lot of the core of our underwriting. And that's where we would say, like, if you want to focus on where AI is being used, is really to understand the climate better.
Yeah.
And I would riff on that for
go
one sec.
ahead.
Sorry, Matt. I think like that's like a great way to describe the shape of the question, or I guess like the shape of the problem. I think like there's like the parametric market's been around for a long time, frankly. It's like since like the 90s when these products were originally offered. And so like the data's been around for that long, and models have also been around for that long. And certainly data has gotten better, right? It's gotten more frequent, less latent. Models have gotten better. But like, and what we have not seen is like those improvements resulting in the market for event-driven products expanding in the way that many people hoped and thought it would. And so I think it's worth asking like the extent to which this problem is a modeling problem, is a data problem, versus, I think, to a point that Bessie made earlier, a problem about, let's say, market education, about scaling some of these issues with software versus the data and the models themselves. And I think like the seasonal versus sub-seasonal issue that Sid raised is a great description of that, because like, sub-seasonal models for sure have gotten a lot better, but insurance carriers still think of the world in annual terms. So it's like for a problem like that, it's like the models have gotten a lot better, and surely for derivative use cases, right, that matters a lot. If you're pricing a 2-week, the likelihood of a rainfall within a 2-week harvest cycle or something. But for the perspective of the carrier, if that fundamental product structure doesn't change to subannual, it's like a much more muted impact on how they kind of like think about the world as well.
Yeah, if I can riff, since we're riffing. Yeah, I mean, I in many ways agree with that we've not seen, I think, the potential or big promise of parametric product in the insurance industry. I think hit what we all think clearly in this room is their full potential. I do think there's some areas where there's some peril specifically where the market is really starting to grow and hit what, I think some estimates I'm seeing is like a few billion in premium. And that's for, I think, named storm or wind, hurricane, and then quake. There's certainly others exist there. And these are places where there's fairly reliable, and has been for a while, data sets where everyone kind of comes together, and this is a pretty accepted, or at least like fairly trusted way to know a earthquake of basically this size happened in basically this area, and therefore we will execute the insurance on this level. I do think that having more reliable, and beyond that, just like actually trusted data sets that are like that, I think it is the starting point, to Max's point. It's the starting line by which we can then build up the rest of the ecosystem around it. But I strongly think the potential is there, in the sense of coming back to what we were talking about earlier. Now that we have, I mean, many of us agree, the reliability around many of these, I mean, let's just say, in my case, sort of a direct observation of flooding through satellites and computer vision anywhere in the US hourly, what kinds of products could then we transact on top of it? And how does that balance out what Sid was talking about earlier, the risk that he may have on his books or another carrier may have on their books elsewhere? So now that we have the data, can we add in diversified risk into these books? And I actually think we're starting to see states, to come back to the regulation, that are pretty eager to see these new products come in. So you just take a state like California, which we do a decent amount of work in. There's obviously a lot of bad insurance news that's been coming out of California recently. Pretty problematic for the state. We can certainly talk about why that is the case. The flooding is actually sort of a less understood, but a fairly significant peril there. Atmospheric rivers cause over $1 billion of damage every year. It was $7 billion in 2023. There's a very low penetration there, but now the state is really eager to add in more products that can cover that, parametric or otherwise, and the carriers are thrilled to get more risk there, and so it just makes commercial sense to balance out. So, just kind of a winding thing to say, like, as we can take a step back and think about how we grow this stuff layer by layer with the availability of data, building out some of the regulation components and lining up the incentives of everyone to just make these things commercially viable, and I think start really pushing through to hit some of the potential that I agree with you, Max, and Sid, is certainly not fully fulfilled right now.
Well, I know we're running very low on time, so I think we're going to do a very quick, maybe not the right word, but lightning round. All right, I want someone to name a place in the United States, not California, not Florida, not Louisiana, where you're really seeing an uptick of interest in these products. Sid, start with you.
Well, we do a lot of work in the Midwest, so I would say that Texas and Oklahoma and those areas.
And is that flood, wind? What is?
It's more agricultural drought. And by the way, one of the world's largest parametric programs is actually run by the U.S. government for pasture and drought. called the PRF program, showing that if you design the program well and put the right, subsidies and all the different regulatory things, the market is there and helps with customer education. But those are active areas for us with various crops in those.
Great, Max, and same question to you.
Cool. Anywhere where storm surge is significant, particularly where that surge is hurricane or storm driven, but after the storms have been kind of like graded below hurricane status. So I'm thinking of like the New York region, right? Everyone says Hurricane Sandy. Sandy was a superstorm when it hit New York, and yet still caused massive flooding damage. We're seeing a lot of demand for flood in the New York area. Products are usually government sensor based and or installed sensor based.
And Bessie.
I also think the Midwest and Texas is interesting, but I'll actually just say that I think the banking industry, I think is going to be a big place that takes this up. I actually think using products like this in order to address credit default and bankruptcy is things that we've seen across various sectors. So we have products that are looking specifically at agricultural loan default. So if a major event happens and the farmer can't pay back their loan, that's a problem for the farmer, the bank, and the bank's customer in future years. And I think as we're just looking at the amount of climate risk that's baked into the banking industry now, I think products like this are going to look really attractive at the point of origination or even just putting insurance in after the fact. And I think we're going to see a lot of creativity there.
Well, I think that's as good a note as any to end on. Obviously, a lot of exciting stuff happening in this space, and I'm sure we'll be hearing a lot more about all three people and all three companies on this panel. So Bessie, Max, and Sid and SOSV, thank you so much for taking the time to do this and for bringing this together. I learned a lot, and hopefully everyone in the audience did as well. Thank you.